Let's start with the chairman's speech today. He was basically right down the middle. Some people want us to raise faster, some people want us to raise slower. I vote for let's be cautious, risk management, slow, gradual pace of increases. Anything in there that you disagreed with?
No, the funny thing was his speech mirrored exactly my life. So when I go around and talk to people, half the people pull on one arm and say, you guys are going too fast, you need to slow it down. The other half saying, you know, you better watch out because we're about to overheat, you need to speed up a bit. And so we get pulled in all these directions. For me, I think it's been helpful just to level set and say, you know, everyone's got their view and perspective, and I've got to figure out how to bring it all together. And I think on balance, the slow, steady, take an action, stop, and see how the markets respond approach is one that makes a lot of sense.
You've sort of said you're in the camp of let's get to what we think might be neutral and then pause. What do you mean by pause? Does that mean that one meeting goes by, or is there a time frame on that?
Well, for me, and I can only speak for myself, I think that pause means wait until you get a signal that the economy is going in a direction that we're not comfortable with. So, you know, we've been in a stimulative position for a long time, and I think the whole impetus for going slow was that we wanted to make sure the economy had legs to stand on its own. I think we're there. I think we're getting a lot of signals to suggest that's true. So if that's true, then we can just stay in the neutral position and then really just wait until we get some signal of directionality in the broader economy.
Well, the signal for many people would be that inflation starts to accelerate, but we're not seeing that. How concerned are you that that might happen?
That inflation might accelerate?
Might accelerate.
It's something I'm watching. So, you know, when we talk to business contacts throughout our district, we're seeing more businesses and more employers say we're having to increase wages because we're struggling to find workers to fill our positions. And it's happening in segments that we hadn't heard before. We knew about nurses, we knew about truckers. Now I'm talking to people who run hotels, people who run restaurants, and they're also starting to feel wage pressure. So to the extent that it starts to broaden, and we see an acceleration in wages, which then translates to an acceleration in market prices, I'll be concerned.
Speaking of people you talk to in your district, we're not seeing evidence of tariffs in the data yet. But what are CEOs telling you? What are companies doing in the Atlanta district?
Well, our business leaders, they're definitely feeling it from an input price perspective. We've got people who use steel as an input, who use lumber as an input, and they are definitely telling me that, you know, they're facing a higher price point for the materials that they need. Some of them actually had orders for futures, so they had locked in a price and didn't have to respond with the higher price so immediately. But today and now we see, I'm hearing many more businesses say, look, the pricing pressures are real, and we're going to start to think about how we transfer that into final good product pricing.
Do you think that they're going to have the pricing power, or are people just going to have to take it and then we see inflation start to accelerate?
I don't know. We'll see how consumers respond, and my guess is that it'll actually be market segment to market segment, and we'll have to really do some sort of aggregate accounting to get a sense of is this going to translate into measurable inflation that suggests that we're at a higher rate.
What about business investment? Is anybody holding back now because of uncertainty over tariffs?
A lot of businesses are holding back. You know, one of the things that I expected coming out of the tax reform was that businesses would use the windfall to start to invest in new productive approaches to increase productivity of workers and increase output. For most businesses, we've not seen that happen at a robust pace. We do some surveys. We have a survey of business uncertainty, and the message we've gotten is that for most businesses, they're stepping back and they're saying, let's wait and see how the rules shake out and what turns out to ultimately be the field of play. And then we'll make a decision about capital investment. The other thing that we've learned is that my expectation about immediate response probably wasn't right. That a lot of businesses, when they think about their capital plans, they're doing it in a 5 to 7 year period. And if they're well on into that, they're telling us that that's too far down the road for us to just scrap it all and start again. And so we may start to see some of the investments happen further down the road than we had initially thought.
How does that affect then, that input, your forecast for growth over the next 12 to 18 months?
Well, it's definitely introduced some uncertainty, and for us, and my forecast, it's caused me to think that out-year growth is going to be a bit higher than it would have been otherwise. And as we return back, so my models have us returning back to the productivity level and the output level that is steady state for long run, which is somewhere in the 1.9 range. I think that that we should start to expect that those changes and the impulse from the stimulus will cause us to push out when we actually get back to that steady state. So we had us going back there in like 2020. It may be 2021 or even 2022.
Do you think it raises the so-called neutral rate?
We'll see. So part of this will have to do with to what extent does it change expectations about inflation. And in terms of production, a lot of the packages that were passed have a temporary aspect to them. And so there is a potential that at some point down the road, businesses and consumers are going to say, well, this is a short-run thing, and then I'm going to return back to what I was doing before. And so that's something we're going to try to watch and keep track of.
I have to ask you about a speech you gave last week where you pledged not to do anything to deliberately send the yield curve into inversion. But how do you know that your move is going to necessarily do that?
Well, we've been trying to unplug, to really take apart the aggregate yield curve and understand which components are associated with the economic changes. So you know that the yield curve has two pieces. It has sort of a risk-adjusted projection about the path of our policy, and then there's a term premium. Our staff has done some analysis to suggest that it's really that risk-adjusted part that is the most important thing to track. And what we're seeing is that that part of the yield curve is not as flat as what we're seeing in the broader marketplace. The term premium has shrunk considerably over time. So we're monitoring where the market thinks we're going to be, and we want to have a good sense at a very early time about whether the economy is going to change, and we're close to the edge. Another thing I would say is, I talk to a lot of businesses, and I ask them all the time, sort of, what are the things you're worrying about? What weaknesses are you seeing, and do you think that there are changes and challenges that are on the horizon that people aren't talking about? Because I definitely think that it's important for me to try to look beyond what the data tell us so that we can do policy in a timely fashion.
Are you, by doing that, making that pledge, sort of giving the bond market, though, veto power over Fed decision?
I don't think so. What you see in the marketplace is an aggregation of a lot of viewpoints. And so I read all of these things as a summary statistic of the sentiment that's in the marketplace, but we've got to do a lot of other things to really be sure about the trajectory of the economy and of policy. And we just released a blog on the yield curve a couple days ago, and I think it was actually yesterday. And in that, I say pretty clearly, it's a signal, but it's one of many signals that we look at. And so there's no one statistic that will determine definitively where policy is going to go.
I know if I ask you what effect the president's tweets about the Fed have on your decision making, I know what you're going to say. We'll do what we have to do. But do you worry that the president might be trying to set the Fed up as a fall guy for a cyclical downturn?
So I don't think about those things at all. So I just try to focus as much as possible on the job at hand, what the data is telling me, what my contacts are telling me, so that we actually don't get to that cyclical downturn. I mean, we're going to try to do all that we can to continue the robust growth that the economy has had over the last 9 years. When we get to a downturn, if that happens, I'll sort of deal with that and face that when we get there.